Welcome back to Paramic Financial, and this is Jonathan Tran with Finance in 5 to 10 minutes. So the last episode I was talking about, taxes, like when should we pay our taxes, or why would I need to pay taxes, right? Under what circumstances when you receive certain forms. And then also like key dates that you need to remember when it comes to taxes. A lot of times people always ask, hey John, what's new for 2020? In 2020, as you know, we got hit bad with the coronavirus. And one of the key things that a lot of people are maybe question or not sure about is that corona stimulus payment that I received. If you were single, you received $1,200. If you were a married couple, you received $2,400. And if you had any children that you were claiming, you received $500 if the child was under 17. And so these monies that we receive, these are a rebate. So you don't need to pay the taxes on receiving these money. So some people were concerned saying, oh, what if I receive this money? Do I need to save the taxes on it? No, you don't need to pay taxes on it. Now, for some people I know out there that did receive the money, but maybe they didn't get the money for their child, maybe because the child was over 18. So on your 2021 taxes, when you file them, you'll be able to claim that $500 that you didn't get. So for those people out there that said, hey, no fair, I didn't get my money, yes, you're going to get your money for claiming that $500 when you do your tax in 2021. So that's the first things first. There's 10 things total I want to talk about. The second thing is unemployment. Wow, everybody's receiving unemployment now, right? Due to coronavirus. It's very unfortunate. A lot of businesses went out of business or people got furloughed, reducing task force down. So unemployment went at all-time high. Millions of people were on unemployment. And so these monies that you receive from unemployment, these monies are taxable because it's considered as a form of income for you. So when you claimed your unemployment, you could have one, just taken the full amount and then you deal with the taxes later, or you could have deducted the taxes out ahead of time and received like your net afterwards, right? So for those people who did receive unemployment, that is taxable income. By the end of the year, or beginning of next year, you will receive a form from unemployment so that you can file your tax. So don't be too surprised that, oh, what happened? I owe this money. Yes, unemployment is taxable, right? So keep that in mind. So that's number 2. Number 3, like I said earlier, you still can receive a $500 credit for your child in 2020 and 2021. So just make sure that when you go and file your taxes next year, that you disclose whatever child you have that you take care of, then the tax person can notate that, and then you can get that $500 credit on both your 2020 taxes and your 2021 taxes. Number 4 is there is a standard deduction. So anytime that you make income, the government gives you a standard deduction so that you can lower your income down, and then you pay taxes on what's after your standard deduction, right? And so this year is increased up to $400 from last year. So if you're like a married couple, you're at like $24,800 now. So you get a little bit of a $400 break. It's not much, but hey, $400, maybe you save like $20 on tax or whatnot, but hey, money saved is money saved, right? The 5th thing that we want to talk about is retirement accounts. So if you work for a company and they offer you a 401k, the limit has been increased to $19,500 a year. If you're using an individual retirement account, an IRA, you get to put in $6,500 now instead of $6,000. So for those of you who are looking for ways to kind of legally lower your taxes down, lower your income down so you can pay less taxes or maybe qualify for some credits, the 401k plan and the IRA plan is a very good way to lower your taxes down. And then later on, when you retire, when you take that money out, then you pay taxes later, right? So you get the benefit today, and then you get to pay the taxes later. Now, on the flip side, there is another IRA account called a Roth IRA. And the benefit of the Roth IRA is that money that you put in today in the Roth IRA is already after taxes. So people may ask, well, what kind of benefit do I get for putting into a Roth IRA? Well, the benefit is that any money that you grow in the Roth IRA until you take it out at retirement, all the interest earned, you never have to pay taxes on it because you already pay the taxes today. So the government says, hey, you know what, if you still want to save for retirement and you don't need to use an IRA, well, you can use a Roth IRA and you can defer your taxes and also never have to pay taxes on the interest later on in life, right? So very good, can increase the limits by 500 from last year. So 6,500 for Roth IRAs, and then 401ks is 19,500. If you are over 50 years old, you get a catch-up provision where you can do an extra 1,000 on top of that, right? So if you are close to retirement and you feel you're a little bit short on your savings, an extra $1,000 could put you a long way, right? Another change is donations that you like to make. So if you donate to your church, your temple, or any organization, especially with COVID happening, a lot of people were asking for aid, and if you donated to any of those causes, you can deduct up to $300 this year for 2020 for your donations. The next thing is that estate tax. So for those individuals who are passing assets down to their family members, the estate tax is up from 11.4 million to 11.58 million. That's a lot of money. Maybe those who are very wealthy have to be concerned with this, but many people probably don't have $11 million to pass on. So when you pass your assets down to your family, you won't have to worry about incurring any taxes on that. Okay, and that's if you're a U.S. citizen. Now, other things that people may ask is that, hey, more corona-related help in taxes, right? CRD, or other known as corona-related distributions. The first one is for your retirement account. So if you have a 401k, an IRA, or a Roth IRA, and normally if you withdraw the money prior to being 59 and a half, there's a 10% penalty that you got to pay, right? 10% is a lot, because think about it, you pay 10%, then you have to pay the taxes on it, and just factor maybe taxes are 10 to 20%, well then you lost a total of almost 30% in your account. Depending on your income, you could lose even more, right? So due to corona-related distributions, the IRS is allowing you to withdraw money from your retirement accounts without a penalty, and you only need to pay the taxes owed on it in that year. Now, there is a special provision that if you took that money out due to corona-related, and if you put it back within the next 3 years, then the IRS will deem it as a rollover, and then that means that you don't need to pay taxes on it, right? And if you pay taxes, then you get that money back. So keep that in mind. If you took some money out because you had some hardship, but you're able to put that money back into your retirement account, then the government will deem that as a rollover, and then you won't have to pay due taxes on that, right? So very, very powerful. Definitely use that in your strategy if you need to. Other things is if you work for a company and you are able to take a loan from your 401k due to corona hardship, then they will allow you to take the loan up to $100,000 and defer that payment for 1 year, right? So the cap is $100,000. You can't borrow more than that. But if you borrow up to $100,000, they will allow you to defer those payments until 1 year, right? So that way you can borrow that money, use it for what you need to use it for to get back on your feet, and then 1 year later you can start making the payments back to that plan. Now, if you have any outstanding loans on your 401k plan, the deferment can apply to those current loans as well, as long as they're under $100,000. So another very powerful tool to assist us during the coronavirus time. Also, for those of you who are 70 and a half and older, you are subject to something called RMD, is a required minimum distribution, meaning that any money that you have in your retirement account, if you become 70 and a half or older, you are required to take a certain amount of money out of your retirement account, or they will penalize you for not taking it out. Due to coronavirus, they are waiving that reason for you to take money out for this year. So if you have a RMD that you need to take for on your account because you're 70 and a half, you're able to defer that till next year due to corona. RMD age also has increased from 70 and a half to 72. So now those of you who have not hit 70 and a half yet, then you can wait till you're 72 years old. Now, if you're already in RMD and you're already paying, then you just continue to make the withdrawal as normal every year. But if you haven't hit 70 and a half yet, then now you can wait till 72 to take your money out of your retirement account. So very good. And the last thing is Earned Income Credit, EIC credit. A lot of people that have taken care of children love this credit. If you have a certain level of income, either low income to medium income, there's a calculation for it depending on each person in their household. But the maximum credit that you can get back now for the Earned Income Credit is $6,660 this year. It went up from $6,557. So that's money, credit to you, money in your pocket, right? So if you take care of kids, the government also gives you some help. Of course, it's not everything to take care of our kids, but something better than nothing, right? And so these are the things I see that are the biggest, most important changes in 2020. If you have any comments or questions, please comment below. Please subscribe to our link so that you can get more information, more content from us. And I'd love to bring more information to you guys. Thanks a lot. Bye-bye.